Let me say this first. This video is for education, not financial advice, not a recommendation, not a judgment. Everyone's life, income, family situation, and goals are different. So nothing here is about telling you what you should do. It's about helping you understand the system so you can make calmer, smarter decisions inside it. Because buying a home is emotional. It's not just a purchase, it's identity, it's security, it's I made it. And when a bank says you're approved, it feels like permission to relax, like someone in authority just told you you're safe now. Tonight, we're going to gently question that idea, not to scare you, not to shame you, but to give you something better than approval: clarity.
It usually happens on a normal day. You're at work, or on the couch, or standing in line somewhere, and your phone buzzes. An email from your lender. Subject line: "Congratulations, you're pre-approved." You open it, and there it is. A number. 300,000, 400,000, sometimes more. For a moment, your chest feels lighter, because for months, maybe years, you've been thinking, can I even afford this? Am I falling behind? Will I ever own something? And now, someone official just said yes. You screenshot it. You send it to your partner, your parents, your group chat. People reply with emojis, fire, claps, hearts. Let's go. So proud of you. Homeowner soon. That night, you start browsing again. Bigger kitchens, better neighborhoods, nice lighting, backyards. You imagine holidays there, kids running, quiet mornings, a sense of arrival. And slowly, without realizing it, the question changes. It's no longer, can we afford this? It becomes, which one should we pick? But underneath that excitement, there's something else. A small, quiet voice. The one that asks, why does this still feel scary? Why am I nervous even after being approved? Why do I feel like one bad month could ruin this? Most people ignore that voice because the approval feels louder. And tonight, we're going to listen to it.
Let's clear up the biggest misunderstanding in modern home buying. When a bank approves you for a mortgage, they are not saying you'll be comfortable. They are not saying you'll be stress-free. They are not saying this fits your life. They're saying something much narrower. They're saying, based on what we see right now, you can probably make the payments. That's it. Approval is a math test, not a life test. The bank looks at a few basic things: your income, your debts, your credit history, your recent stability, and they ask one question: if everything stays mostly the same, can this person send us a check every month? Not, what happens if they get sick? Not, what if their partner loses a job? Not, what if childcare doubles? Not, what if rent, food, and insurance all rise at once? Because those things are your problem, not theirs. From the bank's perspective, as long as the loan gets paid, the system is working. So approval doesn't mean you have room to breathe. It means you passed the minimum standard. Think of it like this. Passing a driving test doesn't mean you're a great driver. It means you didn't crash during the exam. Mortgage approval works the same way. It means you didn't fail today, not you're protected tomorrow. And once you understand that, a lot of housing anxiety suddenly makes sense. Because deep down, you know the approval letter isn't a safety net. It's a starting line.
To understand why approval feels safer than it really is, you need to see what the bank is actually checking. It's not complicated. It's a checklist. First, income. They look at how much money comes in every month, usually your base salary, sometimes bonuses, sometimes side income, but only if it looks stable. Not how hard you work, not how stressful your job is. Just, does the paycheck arrive? Second, debt. Credit cards, student loans, car payments, personal loans, everything with a monthly bill. They added up. Third, credit history. Have you paid on time before? Do you have a long record? Any major defaults? This isn't about character, it's about patterns. Fourth, reserves. How much money you have left after closing. Sometimes it's 2 months of payments, sometimes 3, sometimes more. Enough to survive a short hiccup, not a storm. Then they combine it into one main number, debt-to-income ratio, DTI. It's simple. How much of your monthly income is already committed before you even buy the house? And most lenders are comfortable letting that number climb high, sometimes over 40%, sometimes close to 50%. Meaning half your income can already be spoken for before groceries, before childcare, before savings, before life. And still, you're approved, because on paper, you fit. Nothing in this process asks, do you feel constantly exhausted? Are you supporting family? Are you burned out? Do you want freedom? Do you want flexibility? The spreadsheet doesn't care. It only sees income in, payments out, green light. That's how someone can be approved and still feel one paycheck away from panic, because the system measures survival, not comfort.
At this point, a natural question comes up. If thin margins are risky, if high payments create stress, why do banks approve people so close to the edge? Are they careless? Are they predatory? Most of the time, no. It's simpler than that. It's incentives. Banks are businesses. Their job is to lend money and earn interest. More loans means more revenue. Larger loans mean more revenue. So the system quietly rewards maximizing approved amounts, not minimizing your stress. A loan officer doesn't get promoted because your life is peaceful. They get rewarded because deals close, because volume moves, because targets are hit. And even when people inside the system care, they're working inside rules designed for scale. Automated underwriting, standard ratios, risk models. Everything optimized for how many loans can we safely approve, not how many lives can we keep calm. From the bank's perspective, if you pay on time, the loan is good. If you struggle but still pay, the loan is still good. If you default, they have insurance, they have reserves, they have property, they are diversified. You are not. One mortgage is a tiny line item for them. It is your entire financial life. And that imbalance matters. Because when incentives reward stretching, stretching becomes normal. 40% DTI becomes acceptable. Then 45, then more. Technically affordable becomes market standard, not because it's healthy, because it's profitable. This doesn't mean banks are evil. It means the system was never designed to protect your peace. It was designed to move money. Once you see that, you stop taking approval personally. It's not a blessing. It's a business transaction. Let's make this concrete. Meet Daniel and Priya. Not real people, but very real numbers. They're both in their early 30s. Daniel works in tech support. Priya works in healthcare administration. Together, they earn about $95,000 a year. Solid jobs, good credit, no major red flags. They've been renting for years, watching prices rise, feeling fresher. Friends are buying, parents are asking, social media is full of closing day photos. So they finally decide, let's try. They meet a lender, submit documents, wait nervously, and a week later, they're approved, up to $420,000. They're shocked. They were expecting maybe $320, maybe $350, but $420,
It feels like permission to dream bigger. Better school district, safer neighborhood, shorter commute. They find a house listed at $405,000. It's clean, updated kitchen, small backyard. They fall in love. After a little negotiation, they get it, with 5% down. Their monthly payment, mortgage, taxes, insurance, comes out to about $2,650. The lender says, you're well within guidelines. Friends say, you're building equity now. Parents say, good decision, rent is wasted money. So Daniel and Priya move in. They feel proud. They did the responsible thing. But now, let's look at their real life, not the approval letter.
On paper, Daniel and Priya look fine. They earn about $95,000 a year. That's roughly $7,900 a month before taxes. After federal taxes, state taxes, Social Security, health insurance, they bring home around $5,800. Sometimes a little more, sometimes a little less. Now let's line up their life. Mortgage, taxes, insurance, $2,650. Car payment, $420. Student loans, $280. Phone plans and internet, $160. Utilities, $220. Groceries, $600. Gas and commuting, $180. Basic subscriptions, $60. Minimum savings contribution, $300. Added up, that's about $4,870, out of $5,800, which leaves around $930 per month for everything else. Clothes, medical copays, birthdays, travel, home supplies, unexpected fees, car repairs, helping family, life. $900 sounds okay until you realize that's their entire safety margin. That's what separates fine from stressed. One emergency room visit, one broken transmission, one unpaid week, one insurance increase, and that cushion disappears. And here's the quiet part. The bank saw none of this. They didn't care about groceries, or gas, or birthdays, or stress. They saw income, check, payment, check, debt, check, approved. But real life doesn't run on ratios. It runs on margins. And Daniel and Priya's margin is thin. When people calculate whether they can afford a home, they usually focus on one number, the mortgage, maybe taxes, maybe insurance, and they stop there. But home ownership doesn't arrive alone. It brings a stack of quiet costs with it, costs that don't show up in approval letters. First, maintenance. Roofs leak, water heaters fail, HVAC systems break, pipes clog, appliances die. Not dramatically, randomly. 1,000 here, 2,000 there. Over time, it adds up. Second, insurance. Home insurance rises. Flood zones change. Climate risks increase. One letter in the mail, and suddenly your premium is 20% higher. No negotiation. Third, property taxes. Cities reassess values. Budgets change. Schools expand. Your house gets worth more, so your tax bill does too, even if your income doesn't. Fourth, utilities. Bigger space, older systems, less insulation. Heating, cooling, water, trash, all quietly higher than before, every month. Fifth, commuting. Better neighborhood often means longer drives, more gas, more wear, more time. Sixth, furnishing. When you move in, you notice what's missing. Couch, curtains, lawn tools, shelving,
security system. None urgent, all just this once. Seventh, HOA and community fees. Sometimes small, sometimes not, and almost never optional. Each cost alone feels manageable. Together, they form a stack, a slow, steady drain on margin. Daniel and Priya didn't suddenly become irresponsible. They just became homeowners. And homeowners live inside a financial ecosystem where expenses compound quietly. This is why so many people say, I make good money. Why do I still feel broke? It's not failure. It's math.
When your financial margin is thin, nothing has to go terribly wrong for things to start falling apart. It only takes one disruption. Let's go back to Daniel and Priya. Remember, they had about $900 a month left. That was their buffer. Now imagine this. Daniel gets sick. Nothing dramatic, just serious enough to miss 2 weeks of work. His company doesn't offer full paid leave. That paycheck is short by $1,400. Suddenly, their entire margin is gone. They put groceries on a card, delay a bill, dip into savings. Then, 2 months later, their car needs a major repair. Transmission issue. Cost $1,800. They don't have that sitting around, so they finance it. Now there's a new monthly payment, another $90. Every month. Their margin shrinks again. A few months later, property taxes rise, another $120 a month. Insurance goes up, another $60. None of these events are disasters. They're normal life. But when you stack them, the system starts to wobble. So they cut back. No trips, no gifts, no dining out. Stress rises. Small arguments grow. Sleep gets worse. Work performance dips. And now the original problem starts creating new problems. Because financial stress is not isolated. It leaks into health, into relationships, into confidence. Eventually, they're not asking, how do we save more? They're asking, how do we survive this month? This is the spiral. Not sudden collapse, slow compression. A life that gets tighter and tighter until there's no room to breathe. And this is why being approved doesn't protect you. Margin does.
If being approved doesn't guarantee safety, why does it feel so powerful? Why does one email change how we think overnight? The answer isn't financial. It's psychological. First, authority bias. When a bank approves you, it feels like an expert just evaluated your life. Someone with data, with systems, with experience. So your brain assumes they checked everything, even though they didn't. Second, validation. Buying a home is emotional. It's tied to adulthood, stability, success. So approval feels like proof. I'm doing okay. I'm on track. I belong here. That's deeply comforting. Third, social comparison. We don't buy houses in isolation. We buy while watching friends post keys. Parents ask questions. Coworkers talk about rates. Approval becomes a ticket into the group. Not having it feels like falling behind. Fourth, scarcity pressure. Homes feel limited. Rates change. Prices move. Listings disappear. So once you're approved, your brain switches to don't miss this chance. Caution becomes hesitation. Hesitation feels dangerous. Fifth, mental load. By the time you get approved, you've filled forms, sent documents, waited anxiously. You're exhausted. So when it finally happens, your brain wants relief, not more thinking. It wants to rest. All of this creates an illusion. Approval starts to feel like protection, like armor, like a guarantee. But it's none of those things. It's a permission slip. and confusing permission with safety is how stress sneaks into good lives, not because people are careless, because they are human.
So what does safety actually look like? Not approval, not headlines, not what friends are doing. Real safety is built intentionally. Here are the rules that quietly protect people who stay calm for decades. First, the margin rule. Before you buy, after all housing costs, you should still have 25 to 30% of your take-home pay unassigned. Not theoretically free, actually free. Money that isn't already promised. If buying a home wipes that out, that's not security, that's fragility. Second, the emergency floor. 3 months is survival. 6 months is stability. 12 months is freedom. That's how many months of expenses you should ideally have saved before stretching into ownership. Not after, before. Third, the conservative ratio. Forget what lenders allow. Aim lower. Try to keep housing under 25 to 28% of gross income if you can. It won't always be possible, but it's a powerful target. Fourth, the stress test. Ask yourself, what happens if one income drops by 20%? What happens if daycare doubles? What happens if rates reset? What happens if a major repair hits? If every answer is we'd panic, you're too close to the edge. Fifth, the decision checklist. Before you sign anything, ask, do we still save every month? Do we still take breaks? Do we still help family if needed? Do we still sleep well? Do we still have choices? If the answer is no, pause. Sixth, the permission to wait. This is the hardest rule. You are allowed to wait. You are allowed to rent longer. You are allowed to buy smaller. You are allowed to ignore timelines. Peace is not behind a closing date. It's behind margin.
Let's end with something simple. Being approved for a house is not a finish line. It's not proof that you've made it. It's not a certificate of adulthood. It's just a tool. And like any tool, it can help you or hurt you, depending on how you use it. Real financial safety doesn't feel flashy. It doesn't come with balloons and social media posts. It feels quiet. It feels like waking up and not checking your bank app in panic. It feels like knowing one bad month won't destroy you. It feels like having choices. The choice to rest. The choice to say no to bad jobs. The choice to help family without hurting yourself. The choice to breathe. A home is meant to support that life, not replace it, not dominate it, not control it. If owning a house makes you anxious every morning, that's not success. That's pressure with walls. If renting gives you room to save, grow, and sleep, that's not failure. That's strategy. You don't win by buying early. You win by buying ready. Ready with margin. Ready with buffers. Ready with confidence. Ready with flexibility. And if you're watching this while feeling behind, while feeling uncertain, while feeling torn, let me tell you something gently. You're not late. You're learning. You're thinking. You're paying attention. That already puts you ahead. Approval is paperwork. Safety is a lifestyle. Build the second. The first will follow.